I'm gonna just bring up a little PowerPoint just to guide the conversation here, I guess. Um, so this week's material is about corporations, and I know what you're thinking in your soul, in your heart of hearts, that there's nothing more exciting than learning about corporations and where they come from. Recognize that some form of separating the business from the individual has existed pretty much throughout all of recorded history. In other words, since people have started having business, people have tried to say this business is a separate entity from me. And the reason is a couple reasons. One, liability. That's, to say, well, I didn't do that, but the business did it. But the other, and maybe more important one, is capitalization, meaning people want to be able to buy into businesses without having to be part of the management of the business. So they want to invest in businesses. And then that coupled with liability, saying, hey, if I'm just bought into this, I shouldn't bear the liability the same way a manager who's making decisions should. So you can see on the notes on the screen, I mean, the Code of Hammurabi, which is like the oldest set of written laws, had aspects of corporate law in it. That's how old it is. And so that's kind of on the screen there, a brief history. The fact that corporations have been around forever is probably the most important kind of concept to take from that. So recognize that a corporation is a legal entity, meaning from a legal standpoint, it has, it's recognized like a person, okay? And that shareholders are protected from the liability of the whole corporation. So if you invest in Microsoft and then Microsoft fails to pay its debts, you're not liable. In other words, a person can't sue Microsoft and come after your assets if you're a shareholder. They can come after the corporation's assets, but once those are, once those are expended, they can't come after the personal assets of the shareholders, and that's the real value of a corporation. We talked about this a little bit yesterday with or last week with LLCs. The same concept can happen, which is shareholders might lose their limited liability if the corporate veil is pierced, and that's like a legal. It was used in a ruling, and it became part of the common law. The idea of piercing the corporate veil. So here's some examples of how that could happen. One is in the case of fraud. So a closely held corporation is one where the shareholders and managers are kind of the same people. Okay. My mother owns a corporation, and I'm on the board of directors, and my uncle's on the board of directors, and it's her. So it's like the three of us. So as long as we act in accordance with our roles, we're protected from the liability of the corporation. But the minute, we as decision makers start acting fraudulently, then in essence, someone's going to argue that that corporation and those people are not really truly separate, okay? And they can make a case for that. And then the second point is like what's called failure to act as a corporation, meaning all of these things being capitalized from shareholders, having regular meetings, recording the meetings, filing annual reports. These are all state requirements of corporations. So if a corporation doesn't do that, then people, again, suing that corporation can argue they're not really a corporation. They say they're a corporation to try to get some protection, but they don't act like a corporation, and therefore we want to go after the individuals. And the courts have said, hey, if a corporation isn't functioning like a corporation, then the shareholders can't really expect corporate protection. And then always, a shareholder who acts in a management capacity could still be subject to some personal liability, at least as it relates to their actions. Meaning like the CEO of a business who probably is a shareholder, right? A lot of times they're compensated at least partially in company stock. Even they can't just say, well, I'm just an investor, because they're also a manager, so their liability extends as far as that management responsibility extends. Since we studied partnerships last week, just some basic comparison to partnerships. Partnerships are super easy to form. You just do business as partners. That's it. We even read, some people saw in the case briefs last week, that of the concept of partnership by estoppel, meaning if you act like a partnership, the law recognizes you as a partnership. Whereas a corporation, we just learned it's the opposite. Well, not really, but if you don't fully act like a corporation in every way, then people can challenge that if you're really a corporation. Corporations are completed through a pretty complex legal process. You have to apply to the state, and you have to fill out all the right forms and create a corporate charter and hire a lawyer to do a bunch of work for you, in essence. So partnerships easy to form, corporations complex. Ownership, partnerships, the general partners have control. If it's not a limited partnership, then just all of the partners are general partners. Whereas with a corporation, the board hires managers, and that's how it's controlled. In a partnership, all the partners have to consent to any sort of transfer of interest, meaning if you want to sell a portion of a partnership, there has to be unanimous consent among the existing partners. Whereas in a corporation, stockholders can buy and sell their shares freely. They don't have to have anybody else's permission. They can just sell off a part of the business because they don't want it anymore, or they think they can make money on it, or whatever. Both partnerships and corporations share in the profits and losses. Okay. And then in taxation, partnership has what's called pass-through taxation, meaning any profits the business make are passed through to the partners. And one of the real downsides to corporations is they have this, what they call double taxation. Because the corporation is recognized as a separate entity, they have to file their own tax return. So any profits they make, they file a tax return and they pay taxes on those profits. Then after the taxes, if they pass through some of that to the shareholder has to pay taxes again on the dividends. So that's one of the big downsides. One last thing here is corporations are, like I said, recognized as a person, and they have all these constitutional protections, just like people have, including free speech. Corporations can say what they want to, due process, etc. For some reason, though, corporations are not protected from self-incrimination, meaning as a member of a corporation, say I'm a shareholder, and I can be subpoenaed to testify against the corporation. Whereas a person can be subpoenaed, I guess, to testify on behalf of them, or against themselves, but they can invoke their Fifth Amendment right and just refuse to testify. I suppose a corporation, I guess a member, an individual could refuse to testify, but like you can't say like I'm not turning over those papers because they could harm me because you're a corporation. And in essence, what happens is when you file for a corporate charter with the state, you agree with the state to certain terms. The terms of being a corporation are that you will comply with government when it comes to some of these issues. So that's really it on corporations. Of course, you can watch the 45-minute version of this, where there's probably more of me rambling and saying, stupid stories. Admit it, you love them. But that's in a nutshell. That's the new concepts from this chapter. Any questions or thoughts on any of this? Darby, hold on, I'm not hearing anything. Are you hearing me? Yes. And I saw your mute go off, Darby, so I don't think it was, I think it might be me. Hold on.
It was me.
Now I hear you. Now I hear you.
Perfect. Where there's no right against self-incrimination, if you're an employee of a corporation and you testified against it, wouldn't that toast your whole career?
Probably. So there are laws protecting whistleblowers, right? That saying that there can't be retribution against you for testifying to wrongdoing on behalf of the organization. That being said, would you really want to work at a place where you had just like frosted all of the management there by testifying? So the short answer is, yeah, it pretty much will destroy your career, but there can't be direct retribution. Instead, I think there's all the indirect challenges of being at a place that you just testified against.
Yeah, but they find something, you know.
Yeah, and a lot of times then people sue the place, right, and say this was retribution, and a lot of times people win those cases. Although a lot of times the corporation might feel like it was worth it to pay a $2 million settlement to get rid of that person too. To be fair, though, a lot of corporations, when there's, say, mismanagement or things like that, it really is a relatively small number of people within the corporation that are doing that. And there are plenty of times when somebody does like a whistleblower complaint and then testifies against it, and the corporation pays its fine and gets rid of those people, and the person who was the whistleblower moves ahead, and it doesn't damage their career too. It just depends, but you're right. I mean, ultimately, if in life, if you piss off the wrong people, it might cost you. I mean, that's so then it becomes a matter of doing, do I do the right thing even if it might cost me personally?
So if it is a problem at the same job, do you have a problem getting a new job? You know what I mean?
Hmm.
Because of that history, does that make it harder to be hired other places in the future?
It might, depending on the industry and the sort of the culture of the industry. Um, and so, let's say you were working in finance for a big Wall Street firm, and you made a complaint, and the firm got busted, and then you lost your job. Uh, would other Wall Street firms be leery about taking you on, especially if their closets weren't perfectly clean? Yeah, I think so. Um, that'd be like, if you found out that your new boyfriend hated his last three ex-girlfriends, you start to think maybe it's this guy and not the girlfriends, right? Uh, and I think in some industries have more of that culture too. That's kind of like, none of us, the Lance Armstrong doping culture. Nobody's clean, so how dare them catch me? And others have a much more like, no, we're trying to do the right thing sort of culture. Anyway, that's a lot of talking to say, yeah, there's a good chance it could impact your hireability. Why are you thinking of filing a whistleblower complaint?
Uh, I don't have a
No,
job,
no
so
comment. Yeah.
no, I'm just wondering, like because sometimes when companies find out they have something like dirty going on and they report it, like it temporarily damages their shares, but in the long run, they're worth more because they were ethical. I just didn't know if that's how it is for people too. Like temporarily is a bummer, but long term, because of the ethics, it usually ends up paying off.
Yeah, I don't know about usually or not usually. I'd say that I have seen both of those instances work out in real life scenarios where somebody was really, harmed by it, and others where it was exactly that. Other people were like, I want to hire someone like that. And so it's challenging, and there's a lot of, think about it. Anytime you make a complaint that goes beyond the company, that becomes a political move, and political moves are always risky. Um, you know, but I would say again, if you feel like something's wrong, then you kind of have an obligation to do something. Maybe the best, is reporting that internally. But again, some companies, that's like sticking your head out enough to get whacked on the head, and instead of like actually them saying, yes, we want to improve. Any other thoughts or questions?
Earlier, you mentioned like the double taxing. Like if you go back one slide,
Uh-huh.
the partnership as a pass-through taxation, and then a corporation um, is double taxed.
Mm-hmm.
Does You were talking last week about for like an LLC going through and having like your own bank account for that and getting um, like government ID for your business. Does
Uh-huh.
that play a part in how your business is taxed, just having that other ID?
No, not really. It's your structure that has to do with your taxation. So, a partnership or a subchapter S corporation, um, or an LLC that's taxed as one of those. those all have what's called pass-through taxation, which regardless of whether you have a separate tax ID for the business or not, in essence, what you do is you just say the business made this much profit, and then here's all the partners, and I'm going to pass. You fill out a form. So for a partnership, it's called a Form K1, and it just shows uh, a how much of the profits of the business belong to each of the partners. Even if they didn't get a cash payout of that, they still pay for a share of those profits that are held in the retained earnings. Okay. So that's the pass-through concept. The business itself does not file a tax return other than what's called an informational return that just is reporting to the IRS, here's our profits and here's how we distributed them to partners. Whereas a corporation has to file its own tax return and pay its own taxes.
If a business were to keep its own profits, as like for investing in the future into their own business, do they have to pay taxes
Yes.
on that, or would but the business would have to go through and like how would they do the taxes for that, or would they go through and divvy it out kind of
Are you talking about a partnership or a corporation?
For partnership?
Yeah, so the partnership would still file the Form 1065 and the K1s, and the K1s show that, so like my business is a 50-50 partnership with my mother and I. And so if we make $5,000 this year, then even if neither of us took any money out of the business but left it in the business, we would still we would get a K1 for $2,500 each, half of that profit. And then on our schedules, not our schedule, our regular tax form, there's a place to put any profits from partnerships, and we put it on there. So we would pay taxes on that money even if we didn't take any cash out of the business.
Okay. That answered my question.
All right.
So I remember you saying that I don't know if it was on one of the class videos or the videos in the modules, but you had said that your wife was going to to turn her business into an S corp. I was wondering why you guys didn't choose to do an LLC and why you chose the S corp instead.
Sure. So, well, okay. So an S corp gets taxed a little bit differently. The reason we're going to do an S corp is because we want to hire her as an employee of the business, and I felt like the S corp would just provide one more step of separation. But we could choose an LLC and elect to be taxed as an S corp. That's something that's allowed. In fact, I think that's what that's the plan. Okay. We still haven't done it. We talked about it, and I've thought about doing the paperwork, and in the meantime, we're paying extra taxes on what she earns. So here's the thing: is if my wife makes $10,000 one year doing art, then if she's a sole proprietorship, then not only do we pay $10,000 or taxes on that $10,000 for income taxes, but she's also subject to what's called self-employment tax, which is pretty much like Social Security and Medicare taxes. When you work for somebody, you'll notice that they'll take 7.65% out of your pay for that. And then the business itself will also pay 7.65% for a total of 15.3%. If you're self-employed, you pay 15.3, you pay the whole thing, okay? If you become an S corp or elect to be taxed as an S corp if you're an LLC, you can then, my wife could take a salary or an hourly wage for the work she does. And as long as it's a reasonable hourly wage, only the amount that we're paying her as a wage is going to be taxed with that self-employment tax, that additional 15% tax, which is a lot, right? On $10,000, that's $1,500. So let's say we could pay her a wage, and instead her wage comes out to $5,000. Then we're only going to pay $750 in unemployment or self-employment tax. The other $5,000 in profit would be considered just a profit of the business, which would be taxed at a lower rate without self-employment tax. So as a small business starts to grow and starts to have a decent net income, a lot of them will consider doing the S corp route because that lets them pay themselves as an employee. That was a really long answer. Sorry, Cece.
No, you're fine. It was good. I needed to know that.
Okay. That's honestly something I would probably, if you were hitting that point, I might bite the bullet and pay a couple $100 to talk to a CPA about and say, I'm worried, again, if I pay a couple $100 to save $1,000 on taxes, then that's not a bad thing, right? That's a decent investment. Anything else? I love your guys' questions. You guys ask real questions. So that makes it fun. Okay, well, I don't have anything else. So if we're all good, then I guess we're all good. I think that made perfect sense. Yes. All right. Then have a great day and have a great week. And thank you for taking the time. Bye.
Thank you.